USHY with a 6.65% cash distribution yield versus GOVT Treasuries at 3.88%. Who should consider buying one versus the other? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and welcome back to our weekly update. We've gotten a lot of requests about higher yielding income alternatives over the past several months, as short-term Treasury yields have continued to decline. So let's keep going with our income series for 2026 in the first part of this weekly update. Here are the three topics I'll be covering today. 1. What is USHY and where does its 6.65% cash distribution yield come from? 2. How do current rates compare for Treasuries and annuities? And 3. What are the predicted yields for the upcoming week's Treasury auctions? Let's dive in now, folks. What is USHY and where does its 6.65% cash distribution yield come from? Among the higher yielding investments that keep popping up more and more often in some of our Diamond NestEgg regulars portfolios these days, USHY, iShares Broad US Dollar High Yield Corporate Bond ETF, seems to be a particular favorite. Now, our community is already familiar with buying individual bonds versus bond funds, so I'm not going to repeat here how they work in principle and what the risks are. The only thing I'm going to mention is that for high-yield bonds, also called non-investment grade bonds, or less lovingly, junk bonds, the risk of default is much higher than for the investment-grade bonds that are the mainstay on our channel. And that's the key reason why when folks ask about high-yield bonds, especially those who are somewhat newer to bond investing, we have a tendency to steer them towards high-yield bond funds. Investing in individual high-yield bonds via a fund can save a lot of time and hassle for most retail investors. So this is one corner of the bond universe where even we don't really recommend selecting and buying individual bonds as a starting point. If we stick to funds, USHY, iShares Broad US Dollar High Yield Corporate Bond ETF, is well known as the largest high-yield bond fund on the market, with $26 billion in assets at the time of this taping. It is also well diversified with more than 1,900 positions in its portfolio. The average credit rating of USHY is B+, which is a solid rating in high-yield land. And just one reminder about a specific risk here. While the underlying bonds in the portfolio have defined coupons and maturities, USHY, like any bond fund, cannot guarantee a payout to its investors, nor a full repayment of capital. When you buy any bond fund, you will lose these 3 C's of buying individual bonds that we often talk about on this channel for fixed income investing. You will lose some clarity and control, and add some costs versus a direct investment in the underlying product. In any case, USHY is very liquid, with 11 million shares traded per day, and its dividends are fully taxable as ordinary income when held in a normal taxable brokerage account, which you should always keep in mind when comparing yields to alternative options that may come with a tax advantage. USHY's distribution yield stood at 6.65% at the time of this taping. If we compare this with similarly broad-based funds in the iShares family, USHY's distribution yield is 2.77 percentage points higher than the 3.88% for U.S. Treasuries from GOVT, and 1.81 percentage points higher than the 4.84% for investment-grade corporate bonds from USIG, if that's your benchmark. USHY might be something to look at for more advanced and or adventurous bond investors if 1. You like the stable monthly dividend payments and the distribution yield of 6.65%, especially if you consider the extra income it may provide over Treasuries and investment-grade corporate bonds. 2. You like the diversification that a broad non-investment-grade bond fund may bring, potentially reducing your overall portfolio risk. 3. You like that USHY preserves your capital well. In fact, the share price of USHY, the dark blue line here, proved much more stable over the past 7 years or so, and especially through COVID that many REITs, which are often considered another relatively stable, high-yielding, and diversifying investment, as you can see here in this example of the Realty Income Corp REIT, ticker O, the light blue line. That said, there are factors that may speak against an investment in a high-yield bond ETF. For instance, if you just can't get yourself comfortable with high-yield credit risk. As I always say, sometimes those few percentage points are just not worth it if you're going to lose sleep over them at night. If this is you, it may be better to stick to Treasuries and investment-grade bonds. USHY may also not be for you if you don't like that the payouts are generally taxed at your full ordinary income tax rates, which may be especially relevant if you live in a high-tax state and are buying outside a tax-advantaged account, outside of an IRA or 401k, for instance. And of course, if you want to see some growth, some capital gains on top of the ongoing income, you should know that USHY and other high-yield bond funds as well are just not designed to deliver that. For that, you may want to check out some of the secret investments for higher income that we discussed in part 2 of our 2026 income series, link below for your convenience. And if income generation and income protection are top priorities for you as short-term rates move lower, we invite you to get early access to a brand new VIP member community before prices go up on January 15th. We'll be diving deeper into higher yielding income strategies such as USHY and others, as well as corporate bonds, covered call strategies, preferred shares, and principal protected products during the coming year. Our brand new VIP member community is a completely upgraded experience from our old YouTube member zone. And if you already understand the fundamentals of bond investing and managing your portfolio yourself, our Diamond NestEgg VIP member community is the ideal place for you if 1. You're already in retirement and want to have a forum for an extra pair of eyes for critical questions. 2. You're not yet in retirement, but are actively thinking about it for yourself or a loved one and want to get ready to take the decisions that lie ahead. 3. You have questions about how a product works and what the benefits and risks may be. 4. You follow the markets and want to be the first to know about safe and or higher yielding investments. 5. You want to understand new offerings and trends and decide whether they might be something for your portfolio. 6. You want to exchange perspectives with a like-minded community of safety-conscious and income-minded investors who do not want to give up on good returns either. 7. You're a lifelong learner who enjoys discovering hidden investment gems and sharing with others in a more private setting. So, if you check one or more of these boxes, visit our website at www.diamondnestegg.com and click on this yellow private VIP member community button to grab your $100 early bird discount before prices increase on January 15th. They will never be this low again. And get ready for our very first VIP member live happening next weekend. For today, though, let's move on to the next part of our discussion for those of you who are looking for something with less risk than a high-yield bond fund like USHY. How do current rates compare for Treasuries and annuities? As we normally do at the end of the week, let's compare the annuity and Treasury rates at the time of this taping. For this comparison, we'll focus specifically on rates for multi-year guaranteed annuities, MYGAs, from a AA+ rated insurance company that we work with. AA+ is the best credit rating that an insurance company can get from AM Best, which is a ratings agency that specializes in the insurance industry, meaning the lowest risk, making the MYGA rates that we're about to cover most comparable to Treasuries in terms of risk-return profile. And remember that MYGAs work essentially like a CD, similar to a bond, except that MYGAs do not pay interest regularly, but are accumulated in the MYGA account and pay out everything together at maturity. So let's begin with some sample rates for MYGAs. Here you have the investment amount for each investment range, from $10,000 all the way up to just under $10 million. And here's the rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. For example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this AA+ carrier, your rate might be 4.2%. A $50,000 7-year MYGA might earn you 4.3%, and a $100,000 7-year MYGA might earn you 4.45%. And a $1 million MYGA might earn you even 4.5% for 7 years. And if you have more than the amount shown here, say north of $10 million, your rate might go as high as 4.6% with this AA plus insurance carrier this coming week. So basically the same as last week across the board. Remember that because annuity rates track interest rates, this means that annuity rates, like interest rates, are still at above average levels when you compare them over the most recent 20-year period, despite short-term rates having come down in recent months. Do keep in mind that the MYGA rates in this table are subject to change at any time without prior notice, and that your personal rate may be higher or lower depending on a number of factors, including how strongly or not so strongly the insurance company you're buying your annuity from is rated, meaning how risky or not risky your insurance company is. As a general rule of thumb, though, and all else being equal, the higher the rate, the lower the credit rating of the insurance company, similar to bonds. That said, your personal rate will also depend on your investment amount, annuity type and term, state of residence, and other circumstances. Your personal rate is not fixed before you sign your annuity contract. Now, let's move on to Treasuries. There's usually a $1,000 minimum for Treasury transactions with most leading brokers, like Fidelity, Schwab, and Vanguard. Treasuries are more liquid than MYGAs because you can sell them before maturity on the secondary market at whatever the then prevailing market price may be. Do note that MYGAs usually only allow you to withdraw some part of your capital per year without penalty, for example, 10%. This liquidity advantage of Treasuries over MYGAs is also one of the main reasons why Treasury rates are normally lower than MYGA rates. As this table shows, the rates on Treasuries range from as low as 3.54% for a 2-year term up to 3.95% for a 7-year term. And unlike in recent weeks, what we see here is that for a 2-year term and for amounts under $100,000, you're now a bit better off with the Treasury than a MYGA with this top-rated insurance company. For a 2-year term with amounts $100,000 plus, and for anything longer than 2 years, the MYGA rates continue to win over Treasuries, and more substantially so the further out you go and the more you invest. So, if you're comfortable with the illiquidity of MYGAs, their lack of regular interest payments, and the possible early withdrawal penalties before the term ends, or before you turn 59 and a half, and you want to lock in these MYGA rates for the long run, or if you're considering an annuity for the principal protection and guaranteed lifetime income that they can offer, now may be a good time to reach out to your trusted annuity specialist. Annuities come in many different flavors. As I explained earlier, MYGAs, multi-year guaranteed annuities, work essentially like a CD, similar to a bond, except that they do not pay interest regularly, but accumulate it in the MYGA account and pay out everything together at maturity. Whereas FIAs, fixed indexed annuities, allow for potentially higher market-based returns tied to the S&P 500, for example. FIAs come with full principal protection, but also with an upside cap, and might be something to consider if you want to stay in the stock market for the higher returns, but are concerned that we're headed towards a market correction, as we discussed in these 2 recent videos on how to protect your money against a bubble. Link below in the first pinned comment for your convenience. The first-year cap on a 7-year FIA for amounts $100,000 plus still stands at an attractive 9.25% at the time of this taping. For a 7-year cap that stays the same for the life of the FIA, that number also continues to be worth a look at 7.25%. There are also SPIAs, single premium immediate annuities, which can offer an immediate stream of lifetime income and fixed payments, and QLACs, qualified longevity annuity contracts, which are generally used to lower required minimum distributions, RMDs, defer taxes, and manage longevity risk if you have pre-tax retirement savings. Always remember that there's no cookie-cutter, one-size-fits-all annuity solution. So if you're interested in exploring an annuity that's personalized to your individual circumstances, goals, and expectations, shoot us an email at jennifer@NestEgg.com so that we can connect you with our trusted annuity specialist to see what your options may be. Moving on now to our usual table with Treasury yields from this past Friday, versus the previous week across all the maturities that the Treasury issues at auction. This last row here shows the increase or decrease in rates over the past week. Increases in rates are shown in black and decreases in rates are shown in red. So it's a mixed picture here. The very short end and the very long end are all red, meaning lower yields versus a week ago. But the maturities in the middle between 1 year and 5 years are green, meaning higher yields. And there is a bit of yellow for unchanged yields around it as well. These movements weren't all that large this past week. Perhaps the market is in waiting mode while the Supreme Court is trying to decide whether President Trump's Liberation Day tariffs will stand or fall. But if we wanted to spot an emerging trend, then we could say that the overall yield curve continues to normalize. And I say this because the higher rates in green are one step towards filling in the yield dip in the middle, as we call it. In a normal yield curve environment, the 1, 2, and 3-year maturities should carry a higher yield than the much shorter 1-month T-bill. But currently, they pay up to 18 basis points less, even though they tie up an investor for much longer. So, lower rates for the 1 month and higher rates for the middle maturities help in readjusting this mismatch. The normalization of the yield curve can be seen as a good sign, as a normal yield curve is usually interpreted as a bullish sign that the market expects economic growth and maybe a bit of inflation, while an inverted yield curve is taken as a warning sign that the markets are expecting or at least fearing that a recession may be around the corner. Now, let's take a look at Treasury yields from this past Friday versus a year ago on January 2nd, 2025. As before, this last row here shows the increase or decrease in rates since the beginning of 2025. And again, increases in rates are shown in black and decreases in rates are shown in red. This comparison confirms what we discussed in the first part of today's update. Treasury yields are pretty much all down versus the beginning of last year. 75 basis points lower for the 1 month and still 10 basis points lower for the 20-year. And the 30-year stands out in green as the exception that confirms the rule by yielding 3 basis points more. Not that much, but still better than all the other maturities. Overall, though, as you've heard me say often on this channel, rates, especially at the long end, are still quite attractive if we compare them to the average yields over the past 20 years, at least for now. The next major checkpoint for how it will develop will be the next Fed meeting on January 30th and 31st. You can find more details on these Treasury rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that these numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we have a good overview of where Treasury and annuity rates ended this past week, let's move on to the next section for today. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that the 13, 26, 6, 17, 4, and 8-week T-bill auctions are happening as usual. And if we scroll down, we can see that the 3-year T-note, the 10-year T-note, and the 30-year T-bond auctions are also on the schedule this coming week. The 10-year T-note and the 30-year T-bond are reopening auctions, so we already know the coupons on those. At the time of this taping, on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. The 6-week at 3.6, the 13-week at 3.577, and the 26-week at 3.582. For the 3-year T-note, the expected coupon is 3.5, and the expected yield is 3.583. For the 10-year T-note, the coupon is 4%, and the expected yield is 4.165. For the 30-year T-bond, the coupon is 4.625, and the expected yield is 4.812. Please keep in mind that all of these rates can and usually do change all the way up to the time of the auction. And again, I'd like to invite you to come join our brand new VIP member community if you want to learn more about safe ways to generate additional income in 2026 beyond what Treasuries and annuities can pay, either via corporate bonds, high-yielding bond funds, covered call strategies, preferred shares, or other investment vehicles. If you check one or more of these boxes, our brand new VIP member community will be an ideal place for you to learn and share with other like-minded super savers and income investors in a more private setting. Visit our website at www.diamondnestegg.com and click on this yellow private VIP member community button to grab your $100 early bird discount before prices increase on January 15th. They will never be this low again. All right, members, super savers, and Bond Course fans, I hope you enjoyed today's video and learned something new. And see you again very, very soon with more brand new wealth building content for your financial journey.